Good afternoon, everyone. Welcome to our Loan Risk in a Changing Economy webinar. We have three NCUA experts who will help us with this discussion. My name is George Kodria. I'm an instructional systems specialist with the Credit Union Office of Resources and Expansion, and I'm the coordinator for today's event. Before we get started, we have a few administrative announcements. Adjust your computer volume as needed and allow pop-ups. Use the Q&A feature on the right-hand side of your console window to send in any questions that you may have. You may direct the question directly to a presenter if you know their name or if you know the person to whom you would like for the question to be directed. In approximately 1 week, a closed captioned archive will be available in our learning management system. We have an NCUA disclaimer, which I must read for you. The materials presented in this webinar are intended as informative and educational summary of general information on loan risk. The NCUA has taken reasonable measures to ensure the quality of the data and other information produced by the NCUA that is available in this presentation. The NCUA, however, makes no warranty express or implied, nor assumes any legal liability or responsibility for the accuracy, correctness, or completeness of any information that is available through this presentation, nor represents that its use would not infringe on privately owned rights. The slides are intended for educational and discussion purposes and do not constitute legal advice nor replace independent professional judgment. Reference to any specific commercial product, process, or service by trade name, trademark, manufacturer, or otherwise does not constitute an endorsement, recommendation, or favoring by the U.S. government or the NCUA. In today's agenda, we'll have Catherine Baxter, Training Coordinator for NCUA's Office of Credit Union Resources and Expansion, who will give the introductory remarks. I'll introduce our speakers, and our speakers will dive into the discussion, and they will look at areas such as the impact of interest rates on liquidity, emerging risk in lending, CECL accounting implications, and finally, risk-based practices. We'll then proceed to our Q&A. With that said, I'd like to introduce our training coordinator from NCUA's Office of Credit Union and Resources and Expansion, Catherine Baxter. Catherine, the floor is yours.
Thank you, George, and thank you, everyone. Welcome, welcome, welcome to our timely webinar for today. We're really grateful that you're joining us. This is a topic, loan risk in a changing economy, that certainly is timely today. What's in the news, for example? We recently heard about bank failures. We've been maneuvering through the pandemic, and there have been interest rate hikes by the Fed. So now some of this may be new and some of it isn't so new. But as credit unions, the question is, how is it impacting you? How are you managing your loan risk? How are you managing as the economy changes? Well, how is your balance sheet coming along? The credit union industry on whole is in good shape. As Chairman Harper mentioned in his comments, you can read them on ncua.gov. So take heart with that. But why do we need to know this information? Well, because your balance sheets are going to be affected by interest rate hikes. And many of you have been through this years ago because the economy is never stagnant. So what are you going to do, or what are some best practices that you can employ in order to ameliorate problems due to these interest rate hikes in your loan portfolio? And finally, one of the things that we want you to do during this webinar is to take notes, pay very close attention to what our panel has to say, and ask questions. There's no wrong question. We welcome them. And if we don't get to your questions today, the questions will be answered and loaded to our learning management system. And so we want to again thank you for joining us so much. We really appreciate it. And I'm going to turn it back over to George so that we can get started. George?
Thank you, Catherine. Our speakers for today are Nathan Franklin, Trace Hancock, and Walonda Hollins. Nathan has been with the NCUA for 11 years in the Southern region and is a specialized lending subject matter expert. He graduated with a finance degree from Louisiana Tech. He lives in Little Rock, Arkansas, with his wife and son and their dog. He enjoys hiking and skiing in the mountains during the winter and on the lake during the summer. Next, we have Trace. Trace graduated from the University of North Florida with a Bachelor of Arts degree in business and a graduate degree in business administration. He joined the State Supervisory Authority, North Florida in 1995 in the Credit Union Division and spent just under 12 years examining state chartered credit unions. He joined the NCUA in September 2007 as a district examiner, and in July 2021, he was promoted to regional lending specialist. And finally, we have Walonda, who's a senior credit specialist within the Office of Examination and Insurance at NCUA. She began her career with NCUA in 1999 as an examiner in Houston, Texas, and for over 10 years, she's held the Specialized Lending SME designation as Principal Examiner. In addition, she briefly served as E&I's Senior Policy Accountant between 2019 and 2020. She's a licensed CPA and holds the CFE and CAMS designations. With that, Nathan, will you lead the discussion?
Thank you, George. Good afternoon. As George said, my name is Nathan, and I'll be discussing the impact of rising interest rates on liquidity. Oh, sorry, we have a poll question.
Yes, we do. I'm sorry. Which asset range represents your credit union? We have a number of options: 0 to 10 million, B is 11 to 50 million, C is 51 million to 100 million, D greater than 100 million, and E, the choice is not a credit union. You have 30 seconds to submit your response. France.
Yep.
Okay, I can't see the results. Popped
Sure.
up.
Want me to do the results for you, George?
Yes, please.
Okay. It seems like we have a nice mixture here. We have in our 100 million and above, we have about 172. I think that's the majority of our category, and also in the 11 to 50 million, the 51 to 100 million. We also have those that are not part of a credit union. So got a good mixture today.
Thank you, Catherine. Now, Nathan, back to you.
Okay, thanks, George. Sorry about that. As I said, my name is Nathan, and I'll be discussing the impact of rising interest rates on liquidity. As you know, interest rates have increased significantly over the last year. George, could you hit the next slide, please?
Okay.
Thank you. The Fed fund rate has increased 425 basis points since May the 1st, 2022. I'm going to talk a little bit today about the rising interest rates have on liquidity. There are some key items that examiners are finding during examinations. They are a decline in on-balance sheet liquidity, higher dividend rates and cost of funds, loan-to-share and loan-to-asset ratios increasing, share certificate specials being offered to offset declining share certificate balances, loan growth outpacing share growth, and finally, borrowings and non-member deposits being used to fill the funding gap. So, with an increase in interest rates, credit unions are seeing rate-sensitive funds move to the highest bidder, increased costs of management, and a serious need to update loan interest rates, manage liquidity, and stay in line with market rates. This slide reflects the sharp changes in liquidity last year after relatively steady liquidity trends. These ratios are aggregated national totals. The breakdown by asset groups mirrored these trends. As you can see in the top line, cash and short-term investments as a percentage of assets declined by 41% last year after showing an increase the 3 years prior, and the ratio fell below the pre-pandemic average of 12.83% of December 2019. The average loan-to-share ratio increased by 16% in 2022. Share growth is down 73% year over year, and contingent funding sources reflect a decrease in available funding. The total line of credit limit relative to total assets declined 24% year over year, and total draws against line of credit relative to total assets increased by 149%. As always, there is a lag between a change in interest rates and the impact of the changes showing up on a credit union financials. Forward, important for credit union to have strong monitoring and oversight over liquidity, a CECL plan, and to have the ability to proceed us to business. Please. Thank you. Risk management is a critical aspect of managing your institution through these changes. The key items to have in place are governance, identification, monitoring, and control. Okay. Sound governance includes oversight from the board of directors and senior management, robust policies that include limits, processes for oversight, methods for monitoring and identifying risk, and strong internal controls. The board of directors is ultimately responsible for the liquidity risk assumed by the credit union. For this reason, the board of directors' risk management policies address liquidity and contingency funding needs, including understanding the nature of the credit union's liquidity and maintaining that understanding through periodic reviews, establishing executive level lines of authority and responsibility for managing the credit union's liquidity risk, enforcing management's duties to identify, measure, monitor, control, and report on risk, understanding the contingency funding plan for handling potential adverse liquidity events, reviewing the plan periodically, and understanding the liquidity profiles of important subsidiaries and affiliates as appropriate. Next slide, please. Okay. Credit unions should be able to identify risks presented by their balance sheet by using cash flow analysis and projections to determine potential risks. Measuring trends and anticipated changes to the balance sheet through models and analytics will improve your ability to be proactive in strategy changes instead of reactionary. Monitoring should be based on results of trend analysis and should increase in frequency as risk increases. Trend analysis is key in determining the correct strategic plan for your credit union. Controlling risk requires understanding your balance sheet composition, pricing loans and deposits in line with market rates and desired outcomes, and having risk management practices that are commensurate with the level of complexity and risk presented by your balance sheet. Thank you. Back to you, George.
Thank you, Nathan. I think we'll have the poll come up right now. Franz, do you have the poll up?
It's up.
Okay, here's the poll question. My credit union has experienced a decline in liquidity over the past 12 months. A, true, B, false. We have 30 seconds to complete it.
So George, I think we're having some problems with the audience seeing the poll question. Franz, can you look at that, please?
Yeah, the polling, I'm seeing folks answering the polls at the moment.
Okay. All right, let's give it about 5 more seconds and then you can close that out, Franz. Okay. All right. So we have about 171 participants today who said they saw true, they saw that, and 38 said false, and a great majority did not respond. Okay. Thank you to those who participated. Now we have Trace Hancock, who will take us through the emerging risk in real estate lending. Trace, the floor is yours.
Thank you, George, and thank everyone for attending. So my slides, my next 6, 7, 8 slides are a collaboration of working with the industry and my knowledge of federal regulation. And I cover real estate, indirect lending, vehicle loans, and commercial. So here we go. Emerging risk in real estate lending. As we've probably expected, credit scores and payment to income are still the major drivers. However, we're being informed higher payment to incomes are being approved by Fannie Mae and Freddie Mac. Another risk that we want you to be aware of is improper construction and development monitoring. That is a must for real estate lending. You must stay on those draw schedules and within budget, because it becomes a nightmare if that home is not finished for whatever reason. If the lender drops out and now the borrower is stuck, if the builder drops out, the lender and the borrower have to come to some agreement how that home is going to be completed. So from a credit union position, if it's construction or a builder drops out of the loan and the home's not finished, and the credit union has to get involved with a specialized attorney and hopes the borrower wants to complete. So in most cases, for a builder and for the borrower, the credit union will usually have the borrower put up more of a down payment to keep them in the deal. Another significant risk in today's economy is significant increase in homeowners insurance. And we know that this is being realized, especially here in Florida, California. So this also increases the contractual monthly mortgage payment. Next slide, please. Lack of PMI involvement in high LTV loans. PMI has strict underwriting requirements. In most cases, they're highly professional. So it behooves credit unions to keep PMI, the underwriting requirements in the loan, especially from looking at it from getting 2 sets of eyes on the mortgage and ensuring all your underwriting, documentation, and administration is correct. We know that there's geographical areas within the U.S. with declining home values. This is another huge risk indicator. So the main driver continues payment to income, which is monthly payment divided by monthly income. Most lenders like to stay around a safe gauge, which is 25% less. for a monthly payment. However, we know that secondary market is going out as high as 35%. So next slide, please. So my point is here is don't follow market leaders because they can afford the losses. Again, in most cases, for a borrower, home is their highest asset value. So once a borrower receives a collection notice, we're informed that they are immediately paying, again, because they want to protect that. And what we're trying to avoid overall, if home values drop, then it's a possibility we're going to see 2008 and 2009 all over again. And we're trying to avoid that at all possibility. Also factor in and return student loan payments to affordability of the mortgage, because student loan payments are expected to resume in the very near future. Indirect lending. Credit scores, payment to income, again, are the main drivers. Avoid high volumes with new dealers, high auto volumes with new dealers. Sub 660 beacons are not performing well, inflated credit scores, and I'll have a graph on the next slide to support this. So government stimulus through the pandemic. Can you back up one slide, please? Government's increased the credit scores 20 to 30 points, and the financial institutions were not pricing in the higher risk. So they're experiencing higher level losses, they're experiencing higher level collection activities because of the stimulus created. Again, the stimulus from the pandemic created a higher base for credit scores. So the next slide, please. Here's a quick graph of the stimulus payments. You can see in 2019, 2020, and 21, the graph significantly increased. And you can see how the average credit scores increased from 2010, 689 to average in 2022 of 714. So depending on where your tier is in on your paper grades, you might have increase your leniency on your bars might have increased based on the stimulus. And the end result is you have borrowers that probably had higher reported credit scores, and they've received pricing based on that credit score. But in actuality, there are 20 to 30 points less. And so that's creating some issues, some collection issues in the industry. Next slide, please. COVID stimulus, working from home, new and used supplies. These are all issues in response to the pandemic, and especially the results on indirect lending. We have huge valuations due to microchip shortages, again, COVID, employee shortages. So we see an upside in prices of 30% to 60% in vehicle loans. So we ask to mitigate risk that you rescore your portfolio periodically and identify any negative credit trends of your existing members. Next slide, please. Again, payment to income is important with affordability. Don't put borrowers in vehicles that can't afford the vehicle. Another instance is, and we've seen this pre-pandemic, is rolling negative equity into new loans. Obviously, this inflates the LTV, and we've seen some astronomical negative equity being rolled into new loans. That should certainly be a red flag. So that really should be monitored on your portfolio. So due to vehicle shortages, we know that dealers are selling older models with higher mileage. And this in turn turns into major repairs and maintenance. Again, you're at risk as a lender because the borrower may decide to let the vehicle go. Again, analytics is the key to adjust underwriting to meet the risk. Next slide, please. Can we get, seeing the last couple of slides refer to commercial lending, construction and development monitoring. It's important the budget must be balanced to ensure cost overruns are addressed. Be proactive when commercial loans show signs of 30-day past due. Keep track of slow pays and work your slow pays immediately. Get and keep the board involved. We are huge on this at NCUA. We also formed that at a minimum you could have a commercial loan committee, but they primarily understand commercial loans, and we think it's important that the board as a whole understands the risk to commercial lending. Next slide, please. Project cash flow must meet debt service. Lenders will turn down global guarantor support. So they don't specifically look for global, they look for cash flow that services the debt that they're financing. Be sure you're aware of how much Small Business Administration 7A is out on guarantee. Just the slightest error or an error, SBA will reject that guarantee. So that could be a false sense of security. Also know that credit unions are buying into QSOs, buying positions on the board, and these credit unions are participating in loans on the other side of the country. Next slide, please.
This is the end of.
Yeah, thank you.
All right. Let me just let the audience know that the slides to this presentation will be available on our LMS once we are done with today's event. Within a week, the recorded webinar will be uploaded to the LMS and the slides will also be available. Next, we'll have CECL and its accounting implications, and that will be delivered by Walonda Hollins.
Hi, good afternoon, everyone. This webinar section will address the broad implications of adopting CECL. As you're aware, the Financial Accounting Standards Board, commonly referred to as FASB, announced in 2016 the current expected credit losses, or CECL, as the new accounting standard for estimating the allowance account for various credit risk assets, most notably the loan portfolio. This accounting standard eliminates the incurred notion or probable threshold as triggers for credit loss recognition. Instead, you're assessing expected credit losses over the life of the loan portfolio. Another way of looking at this change is that we've moved from determining the loan portfolio risk as of today to estimating the loan portfolio risk as it ages. CECL requires the consideration of various economic factors impacting credit risk. The historical credit loss experience is merely the starting point. You must include forward-looking reasonable and supportable forecasts. Again, you're considering economic factors which may impact borrowers' repayment ability and prepayment speeds. Now, granted, this new accounting standard may seem like a total departure from your experience in determining this allowance account. However, CECL still requires the following. First and foremost, management remains responsible for selecting an appropriate method. Also, management must adopt appropriate policies and procedures for evaluating credit risk in their assets. You're still pooling assets based on similar risk. You must timely recognize credit losses and determine the status of normal non-accrual of interest and charge-offs. And then finally, CECL is scalable according to your asset size and the complexity of your assets. Next slide, please. For most credit unions, the implementation date was January 1st of this year. It applies to all credit unions of 10 million or more in total assets. Now, credit unions with assets less than 10 million do not have to comply with CECL unless expressly required by their state regulators under state law for federally insured state chartered credit unions. The upcoming March 2023 call report should reflect CECL implementation for credit unions with 10 million or more in total assets. Next slide, please. Now, as a reminder, the initial accounting entry to establish the allowance for credit losses is adjusted against the undivided earnings account. Future adjustments occur through the provision for credit loss, also called the credit loss expense account. For purchased financial assets with significant credit deterioration, the amount of expected credit losses is added to the purchase price to establish the initial amortized cost basis. Any difference between the amortized cost basis and the unpaid principal balance of the asset is considered a non-credit discount or premium. This discount or premium is accreted or amortized into interest income using the interest method. Now, for available for sale debt securities, credit losses are recorded using the discounted cash flow approach in an allowance account. These securities must be evaluated individually for impairment if the fair value is less than the carrying amount and you intend to sell, or you are likely to sell or don't expect to recover the amortized cost basis. And of course, write-offs are recorded when uncollectible. Next slide, please. Back up one slide, please. Starting with the balance sheet. Yes, thank you. So you're often wondering where on the call report should you report? Since 2020, you've probably noticed that the NCOA call report included line items for the CECL-related general ledger accounts for both the balance sheet and income statement. At this time, these are the pages and line numbers for the allowance for credit losses. And so, but for future reference, it's best to utilize the assigned account numbers to ensure information is recorded correctly. Additionally, it'll help avoid confusion if there are future call report changes. Next slide. And here's where you report you record provisions or credit loss expenses, starting with the June 2023 call report. And again, this is under the assumption that you've adopted CECL January 1st of this year. And as another reminder, the March 2023 call report will register initial establishment of the allowance for credit losses with the offsetting entry against undivided earnings. Next slide. As with previous call report cycles, the NCOA call report includes a PCA net worth calculation, or its new name, Capital Adequacy Worksheet. This schedule provides a means for measuring the net worth ratio and identifying a credit union's net worth classification. Once you've entered information in Section 1 on this particular worksheet, which is the date of adoption for CECL and the one-time adjustment to undivided earnings, the credit union's net worth ratio is automatically calculated based on the CECL transition provisions, and it's noted in the Section 4 of the Schedule G, near the bottom. And again, it'll show you what the net worth ratio is, as well as your net worth classification. Next slide, please. So just what are the CECL transition provisions? As you recall, the NCOA board approved transition to the current expected credit loss methodology in June 2021. As a result, it temporarily mitigates the adverse impact of the day one capital adjustments resulting from adopting CECL. A credit union qualifies for the CECL transition provisions if, one, the credit union hasn't adopted CECL before its fiscal
first fiscal year beginning December 15th, 2022, and 2, the credit union records a reduction in retained earnings due to adopting CECL. And so, how it works, and again, using the January 1st of this year implementation date. So, this is how it will be calculated. As stated previously, NCUA automatically calculates the transition amounts to determine the net worth ratio and classification. So for the first 3 quarters of the transition period, the net worth classification won't be impacted by the adoption of CECL. For the fourth quarter of 2023 and the first 3 quarters of 2024, undivided earnings and total assets will be increased by 67% of the recorded day 1 CECL adjustment. Then, for the fourth quarter of 2024 and the first 3 quarters of 2025, undivided earnings and total assets will be increased by 33% of the recorded day 1 CECL adjustment until we finally get to quarter 12, where there will be 0 increase in undivided earnings and total assets. And so the credit union's net worth would ultimately reflect the day 1 effects of CECL. And so the whole point of the CECL transition provisions is to spread out the day 1 impact over essentially a 3-year period. Next slide, please. And so finally, I wanted to make you aware that on NCUA's website, there is a CECL resource webpage. It really is an excellent resource. It includes all of the guidance that NCUA developed, as well as interagency guidance. It certainly includes the accounting standard that I've been talking about, CECL, issued by the Financial Accounting Standards Board, archived CECL webinars, and other guidance material. What you'll also find is the simplified CECL tool and FAQs. And what that includes is not just the CECL tool itself, but it'll include the user guide, the model development document, and of course, the simplified CECL tool FAQs. And then there's another FAQ that I certainly want to highlight, because I know our chief accountant has certainly addressed several questions over the course. And so what you'll find is a particular FAQ addressing accounting questions relating to CECL. And I do want to highlight, he addresses the definition of a fiscal year, the definition of adoption dates, and how you go about defining and determining day 1 adjustments for CECL. And then on this webpage, if you still have questions because you just simply can't find a specific question that's addressed on any of the FAQs, there's an email address where you can request additional assistance. And thank you. And this concludes my section of the webinar. So I'd like to turn it back over to George.
Thank you, Walanda. This next stage will be rounding up of risk-based best practices. Nathan, take it away. Nathan?
Did we lose Nathan? Stand by for a minute, audience.
Yes, please.
Nathan, is your volume okay now? Can we hear you?
I can hear you. Can you hear me?
Yeah, we can hear you.
Yes.
Okay, good.
Okay, thank you. Sorry about that, everyone. Okay, I will now briefly discuss risk-based best practices for the topics we have covered today. For liquidity, the key items are governance, ensure sound policy and oversight, and board involvement. Identification, forecast and analyze cash flows using methods commensurate with the level of risk and complexity presented by your balance sheet and operations. Measuring, measure sources and uses of funds. Determine current and potential risks using modeling and analytics, and plan for changes in business strategy. Monitoring. The frequency and level of monitoring should be based on the complexity and level of risk presented by the balance sheet. Controlling. Understand your balance sheet composition, price loans and deposits in line with market rates and desired outcomes, and ensure risk management tools are appropriate for the size and complexity of your credit union. For example, a bucketed sources and uses of funds template or maturity gap template can be used where appropriate, while credit unions with more complex cash flows or cash flows that are susceptible to high volatility need more sophisticated tools to capture the effects of changing market rates or varying assumptions about growth of deposits and loans that can highlight potential liquidity shortfalls. Next slide, please. For CECL, you'll need sound processes for evaluating credit risk, accurate recognition of credit losses, and the determination of policies for non-accrual of interest and charge-offs. Next slide, please. For identifying and measuring portfolio risk, you will want to ensure accurate cash flow analysis and reasonable payment to income limits. Board oversight is critical. Rescore auto portfolios at least annually to identify credit trends for your membership and be proactive in collection efforts. Thank you. Back to you, George.
Thank you, Nathan. Ron, I see we have some questions coming in for our presenters. Can you?
Yes, thank you. Thank you so much to our presenters, and thank you, George, and thank you everyone for being with us today. So our first question that came in is for Trace. So Trace, this is the question: how about green loans and their impacts on LTVs, which was approved by state legislature?
Are we referring to what are we referring to on green loans? Are they evergreen loans? Does it pertain to real estate, indirects, or commercial?
That is a good question. I hope the person who asked that question will put a response in the Q&A chat.
I just need a little more clarification on that question. I mean, that probably something I'll have to defer, but I'm just trying to get a basis for it.
Understood. Understood. Thank you. Well, hopefully they'll respond and we'll come back to that. The next question goes to Walanda. So Walanda, you touched on this and you may have answered this question, so it may be more about clarification, but this is the question. I understand the call report will calculate our net worth ratio by spreading the equity adjustment over 3 years. For our own credit union financial statements, should we also use the same calculation for our net worth ratio, or do we have the option to reflect the whole equity decrease in our first credit union financial statements after CECL adoption?
Okay, it's an interesting question, but the way I would approach it as a credit union is, first of all, you need to understand is that we're measuring it to determine what NCUA is in terms of whether or not you will fall under any form of prompt corrective action. But I would recommend that you understand what the full impact is right away, just in case if you needed to rebuild substantially your net worth. Say, for example, the day one adjustment impacted net worth to where you fell below 7%. You know, I would think that you would want to know that so that you can start strategizing in terms of how the credit union is going to rebuild its net worth position to where it doesn't fall under any type of prompt corrective action. I hope that addresses your question.
Thank you so much, Walanda. And while I have you, I'm going to go ahead and ask the second question that came in about CECL. And it is, can you repeat the CECL phase and period, please?
Oh, well, rather than just repeating it, if you go to the CECL resource page, and on the CECL resource page, it actually has the CECL transition, and it actually shows an example of the impact per quarter. And so that way you can actually take your time and see how it will impact in the actual methodology. So I hope that answers your question.
Good response. Thank you, Walanda. I think that's a good idea. So, Trace, going back to you, the person that asked the question about the green loans responded with this: real estate loans for storm windows or roofs.
Okay, sounds like energy efficient, probably some type of tax credit. What's the question on it again?
Okay, so the first question originally was, how about green loans and their impacts on LTVs, which are approved by state legislature?
All right, that's a good question. We're going to pose that in the background, but just understand that that's a question probably posed to a real estate lender. I've never sat on the lending side of the desk. I've only sat on the regulatory side of the desk, so I can get a response to that, but I'll need a little time to get that answered.
Understood. Thank you, Trace. And so our next question, let's see. Actually, I'm going to go back to you, Walanda, again. The question is, what can we expect during the examination regarding CECL?
Okay, as you recall, well, I'll refer you to the 2023 supervisory priorities, and there's a section on this letter that states other updates, and it captures that what examiners will of course be looking at is your policies and procedures, all of the documentation surrounding the methodology, and perhaps even assessing whether or not you appropriately recorded the day one adjustments. And so I would certainly refer you back to the 2023 supervisory priorities that were issued to all federally insured credit unions.
Very good. Thank you. I'm checking now, and I don't see any more questions.
Hey, Ron, there is one question.
Okay.
And I think this one would go to Trace. It's the one about high volume loans with dealerships. Do you see that one?
Yes, I
Did
do.
you
I
want to
see
ask
it
that one?
now.
Okay.
Yeah, I see it now. Thank you. So the question is, why do you recommend avoiding high volume loans with new dealerships? If the loan looks good, why would we decline?
Yeah, that's a good question, but I think from the industry standpoint that they would want to have a break-in period with that dealer and not initially accept every application. They have to get some kind of comfort with the flow and what they're accepting and how those loans are going to perform. So, and from an indirect standpoint, those that are really good at it, the really good lenders, they're taking a highly cautious approach, and they're obviously booking A plus A, B paper, probably taking some C and D, not a lot, but they're trying to pick up the yield to increase their profitability. But a new dealer, you're taking on high volume. There's a very real possibility you're taking on a lot of risk. So smooth into the process, get a feel for it, get some history behind it, and then make your decision from there. Thank you.
Very good. Thank you so much, Trace. And Trace, while I have you, we have another question that is directed to you. It says, Trace noted a PTI safe gauge of 25% for residential mortgage loans. Any thoughts on a safe gauge level for overall DTI?
Debt to income or payment to income?
I'm sorry. It started off talking about payment to income, but
Correct.
it said overall debt to income at the end.
I had a brief discussion with someone earlier, 2-3 weeks ago. They don't like to put a lot as a lender. They don't like to put a lot of emphasis on debt to income. So you can pose a question. I'll look out in the industry, see what kind of response I get. But again, the driver is credit score and payment to income. I mean, debt to income, it's just, it appears to be not used as much and possibly fading out. Thank you.
Thank you, Trace. The next question is for you again, Walanda. If all investments are government guaranteed, do we still need to calculate CECL on these investments as they are held as HTM?
Good question. And you still need to document, essentially affirming your own understanding that there's zero risk. That's when you look at the FASB pronouncement, it actually utilizes such government-backed securities as an example in terms of the appropriate way for documenting that there's limited or zero risk. So to answer your question, no, but you should still document it. And I will also refer you back again to the CECL resource page and dive a little bit more into the actual accounting standard. It's near the beginning when it talks about qualitative and, you know, the economic factors applied to credit risk assets. And so it'll give you a more comprehensive answer to your question.
Great. Thank you so much, Walanda. So Trace, we're going to go back to you. This is a follow-up to the question about the auto loans, I believe. And the question is, what about Fair Lending Act? How would we deny?
Again, that's a fair lending division of NCUA. It's another question you're going to have to pose. I've never been involved in fair lending. It's a good question, but pose that and in our data bank or whatever, and we'll get a response to it.
Very good. And we have another one, another follow-up for you. This one is about payment to ratio income. They want to know, what is a good ratio of payment to income?
For real estate, vehicles? What?
It didn't identify. I'm not
Okay,
sure.
well,
Maybe the asker can, for vehicles. They responded for vehicles.
I think a good ratio would not to exceed 30% of payment to income. I mean, as I reiterated in the slides, it was 25% for real estate. So, you know, from a vehicle, and again, I'm not a lender, but I would think that 30% would be a pretty safe gauge.
Excellent. Well, that is all the questions that I see, Catherine. I'm sure I got them all. If you see any, please let me know. I want to make sure I don't miss anyone. But I will reiterate. I'm sorry. Go ahead, Catherine.
Oh, no, go ahead. I'm sorry. Go ahead.
I was going to say, we also got questions again to repeat about the PowerPoints, and what George mentioned earlier was this entire recording plus the slides will be available on NCUA's learning management system in about a week to 2 weeks. So with that, unless there aren't any more questions, which I do not see, I thank I'm sorry, go right ahead. I think I see Walanda raising her hand.
Yes, I do see a couple of questions where people were unclear about prompt corrective action and in particular net worth, and how it's calculated. I do want to go back to NCUA's website, along with where there's regulatory and compliance resources on NCUA website. So if you're not really familiar, there's another section talking about the net worth ratio plan and prompt corrective action resources. There's actually another FAQ that will help you identify how we classify the net worth ratio. So I would urge you to go there. And then there's another question relating to a third-party audit. Again, go back to the CECL resources, in particular, the FAQs surrounding accounting questions. There's the chief accountant addressed that particular question in terms of what constitutes a financial audit and not, as well as the implementation date. So I think those questions that I see are definitely available on NCUA's website.
Excellent, Walanda. Thank you. Well, I think that's all the time we have anyway, so I'm going to turn this back over to George.
Do I have time?
Thank you, Ron. Oh,
I'm
go
sorry.
ahead, Trace.
Hello?
Yes, Trace.
Do I have time for one question?
Yes, you do.
All right, somebody's asking a question regarding participation commercial lending across country. And somebody asked for further clarification pertaining to the risk. You know, you're buying into a loan, obviously that is significant distance from you. Are you doing on-site visits? Are you familiar with the borrowing base? But I really have a specific example, and that's why I wanted to address it. I've got a credit union bought into a QSO in Florida, and they participated, believe it or not, in a hog farm way out on the other side, north of California. So, that's just something to consider. That always comes to my mind. And yes, I did say a pig farm. So I can imagine, how you would mitigate risks or something like that is beyond me. But that's just an example I wanted to throw out. Thank you.
Thank you, Trace. That's all for today. Before we conclude today's webinar, I'd like to invite Catherine back. She's been our coordinator for all these years, and Catherine is retiring, so I'd like her to say a few words with us. Catherine.
Thank you, George. And I just want to thank everybody that our speakers, Trace, Walanda, Nathan, and my colleagues, George and Ron and Franz, and everyone that I've had the pleasure of working with as the moderator for webinars for Cure. Like George said, I'm retiring, so I wish all of you well. And I just want to say one last, have a wonderful afternoon, everyone. We'll see you next time, and a great week.
Don't forget, our next webinar is on share insurance and is on April 13th. Thank you for attending today's webinar and have a good rest of your day.